welcome to Sectors Up Close. I'm Elena Casas. Today we're talking European banks and my guest is Chris Beecham, Chief Market Analyst at IG. It's been a rollercoaster few days for the banking sector after US regulators shut the collapsing Silicon Valley Bank on Friday in the second largest failure in US banking history. The British government spent the weekend scrambling to salvage the bank's British arm, which had 3,300 UK clients. And on Monday morning, the Bank of England brokered a sale to HSBC for £1. But while the worst of the fallout may hit the bank's tech industry clients, it raises questions over whether the sector can cope with soaring interest rates. European banks have lost a collective $100 billion in value since late last week, and the plunge continued on Monday in the steepest one-day slide in more than a year. It's dragging down the whole sector, including SVB's saviour and the largest bank on the stock 600, HSBC. But one of Europe's hardest hit banks has problems of its own. Shares in Credit Suisse hit new lows on Monday as the bank undertakes a major overhaul of its operations. It delayed the publication of its annual report following a call from the US SEC last week. Well, to look at what the fallout could be, I'm joined now by Chris Beecham of IG. Chris, hi, thanks for joining us. To start with then, has the fire sale to HSBC stemmed the potential for contagion in UK or European banks?
I don't think so, no. Over the weekend, it seemed as if the regulators had taken the action needed to sort of put a firebreak around SVB and indeed the rest of the sector. But I think that these crises have a way of being self-fulfilling. I think it makes me more concerned that the contagion is moving faster than we thought, really, over the course of the weekend, and that it's becoming, if you like, something of it's gaining its own momentum, and that makes life a lot more difficult for regulators to control.
Now, SVB had problems of its own, of course, linked to the tech industry, but it was also a victim of soaring treasury yields. It had money invested in long-term bonds, which are now not worth what they were when the bank bought them. And that's the case, isn't it, across the banking sector? So how are banks coping with the rapid change in the interest rate environment?
Well, I think, for starters, the bigger banks, and that's mostly the case, of course, in the UK and Europe, where you don't have this big regional banking sector to the same extent as in the US, they have been more insulated. So while they're seeing the brunt of it in their stock prices, it's not yet being reflected in anyone needing to sort of show their hand, if you like. It's far more diversified, and of course, it's far more prepared financially. So they can wear these losses better than a lot of their smaller brethren in the US.
Is a similar situation possible in Britain or in Europe, or is there greater regulation that should prevent this type of collapse happening?
It does look like the regulation is much more sort of prepared for this event. Of course, that's what we thought in the US last week. But it looks like the way that the Europeans and the UK have structured this, it seems that the sector here is probably less at risk, I think. I'm not saying it's immune entirely, but certainly less at risk than in the US.
Credit Suisse, though, as I mentioned there, is suffering not only a major stock price slump, but more than $100 billion of outflows from its depositors in the last quarter. So it seems perhaps the European bank most at risk here. What's going on there?
Well, Credit Suisse is one of those banks that you think it's cheap, and of course it's cheap for a reason. So we've seen that turn in sentiment over the last 4 months in stocks generally, and Credit Suisse is a beneficiary of that. But whenever there's a crisis, the investor reaction is to reach for the sell button, especially in European banks, to sort of move out from the riskiest, I think, and that's why you've seen the pressure in the share price. And again, this depositor element is another question of the stability of the bank, and I think that again it's a self-fulfilling prophecy. I think that the more it goes on, the bigger the risk for Credit Suisse, and the bigger, of course, the risk for the Swiss government itself.
What does this mean then for central bank policymakers? The ECB, of course, meets this week. How has this crisis changed the rate rise forecast?
Well, I think if you'd had central bankers come out over the weekend and saying, well, this means we have to stop now, that might have actually added to the carnage, really. I think for the moment, saying nothing is probably the best bet. And of course, the ECB knows that its turn is coming up very quickly. So what markets are hoping for is that they will come out and say, we're aware of the problems. And even if they do still go ahead with the rate hike this week, which almost for the ECB seems much less likely than it did, that they are prepared to make the kind of soothing comments that investors want to see. But I think it certainly diminishes the chance that this hiking policy can go much further in the medium term.
Normally in this segment, I ask you how one should invest in the topic. Perhaps in this sector, it might be more appropriate to ask what should one do if you are invested in European banks?
Well, there I think you have to be prepared for the risk that this goes lower. I think really the crisis seems to be developing that life of its own that suggests the selling has a lot further to go. And until we get that statement from regulators and the ECB itself, it's unlikely that prices have found a floor. So if your time frame is for short term, then maybe you have to look at cutting back on exposure, I think, for the sector for the time being.
Well, thanks so much for that insight, Chris Beecham, Chief Market Analyst at IG. Well, that's our look at the European banking sector. I'm Elena Casas, and this is Reuters.